What's up, everybody? Good morning, good afternoon, good night. Welcome to the BitLab Academy Saturday stream, the Alpha Series here on BitLab Academy. I cannot wait to introduce you to our guests. We've got Mr. Mark Yusko in the house. Last week, we had a wonderful guest in Jordan Lindsay, and this week we're taking it up a notch. Not better, just different lens on the market. And he's been in these markets forever. And he's probably one of the most articulate people in this space. And he makes it fun to think about investing. He makes it fun to figure out how to break down the data in the market so that you can participate in this market in a way that it doesn't dominate you, that you can make sure that you can take control of your positions and see them grow over time. So without any further ado, let's dive in with our guest, Mr. Mark Yusko. How you doing, my friend? I'm so happy you could be here. Thank you for your time.
No, great to be here, Kelly. And I appreciate your nice way of saying I'm old. I have the white hair to prove it. And it's okay. I wear it as a badge of honor. It means I've survived all those things that came at me all these years. And, one of my good friends has this great line about investing. He says, with every investment, we get richer or wiser, never both. So, we learn from our mistakes and we rebound from them. So I just been a good survivor all these years.
Well, I appreciate that. And I think, you know what, I think the first time you really jumped onto my radar was an interview that you did on Crypto Banter. It must have been 6 months, or it's probably about a year ago. And you made my favorite comment, which I have parroted time and time again, which is when we talk about the difference between asset classes and how, you made the mention of if dresses go on sale, think about Black Friday in America, people run over each other to get a 20% discount. But you see something like the best emerging asset class in the history of the world go on sale, AKA markets are pulling back and people run from it until it gets very expensive again. So what would you say to people in this space, whether they've been in a day, a month, or 10 years, because the emotions never go away. The struggle with trying to make smart decisions never goes away. Yeah. It's all about the strategies we put in place. But what would you say to somebody that's fighting off the boredom right now and they're so frustrated with the markets? How do they contend with that and look at this like it's on sale, or, allocate their strategy in a way that serves them?
Yeah, it is the, $64 trillion question. And, the line is that investing is the only business I know. I've been doing this a long time. It's the only business I know where things go on sale, everyone runs out of the store. And the cheaper the price, the further they run. And to your point, in every other business, you put something on sale, people will run over each other to get it. But in investing, for whatever reason, when the prices start going down, people run away. And it's a sad thing, Kelly. It's why the average investor so dramatically underperforms just a traditional passive strategy. And I'll just give you some numbers. So JP Morgan numbers, 20 years, average stock index about 9%, bonds are up about 6%. And all you had to do is pick one. And you made 6 or 9, or pick 50-50, you made 7.5, or pick some mix. The average investor, 2.5. What? How? Well, because human beings do two things really well. We buy what we wish we would have bought. So we wait and it goes up and we're like, oh, I was going to get it. Oh, it'll pull back. And then it goes up some more. And then we're like, oh, I next pullback. And it goes up some more. And then when the pain is too great, we just buy things, but then we don't think about, well, what does that price reflect about the value? And herein lies I think the biggest challenge of investing. Price is a liar. Price has nothing to do with value. The value of any asset is not its price. I'll give you an example. So this kid just got the 1-of-1 Magic the Gathering, the Ring cards. So Magic the Gathering did this Lord of the Rings series, and they printed a 1-of-1 physical card. It's a piece of cardboard with ink on it and a picture of the ring and some words. And somebody offered him $2.6 million. And he's taking a video of it, and his hand is shaking because he got the 1-of-1. And you're like, well, is it worth is that piece of cardboard really worth $2.6 million? Well, hell no. It's not worth that in any way, shape, or form. But the price is $2.6 million. And because it's so scarce, there's only one of one, maybe you can sell it to somebody else for even more. That person who's going to buy it. It's like Beeple. I don't know if you follow Beeple. He's the artist. And, I'm not, to be fair, and I've never met him, and I probably shouldn't say this, but I'm not a big fan. I think his work is a little jarring for my taste.
Yeah.
But I admire him. Why? Because he's done something that I could never even come close. I have not brushed my teeth every day for the last 13 years. I know that with certainty because there were days on camping trip or whatever. This man produced a piece of art every single day for 13 years, put them into a single work as an NFT. And this guy paid like $59 million for it. And everybody's like, oh, he's such an idiot. I'm like, no, the guy's a genius. That is a one.
You know what? That makes me think about this whole idea of investing. People that have made the most money, large in part, it's not every single one of them, but it's like 999 to 1, not even 99 to 1. It's the strategy of time spent is far more valuable than identifying the diamond in the rough, because it's very difficult to identify the one thing that's going to pop. And I see it every day. Somebody, an influencer might mention a coin and they'll have less than 0.25% of their allocation of their portfolio in it. But somebody else sees somebody talk about it and they put 100% of their portfolio in it. And they wonder why. It's like, no, you scammed. No, you made a stupid decision. Somebody was talking about the broad range of things there, but the people that slowly invest are as boring as it is. Jordan Lindsay was pointing this out last week as well. The more boring it is, the less risk it is, and the more likely it is you can compound on that over time. Time spent.
100%. Look, if you're excited about investing, you're doing it wrong. Right? No, you are. I mean, if you feel really good about things, you're doing it wrong. In fact, it's worse than that. If you make an investment and you feel good about it, you'll probably lose money. If you feel really good about it, you're going to lose a lot of money. If you make an investment and you feel a little sick to your stomach, a little apprehensive, you're probably going to make money. If you feel really sick to your stomach, you make a lot of money. And it's because by the time you and I feel good about it, it's already in the price, right? All the information's in the price. The market has already, and if you feel really good, you're buying something that everybody loves, then you've missed it. And that's why the average individual then rides it over the cliff. And to your point, the idea of not having a discipline and not having a diversified portfolio, not only just across asset classes, but within each asset class, across different assets within that asset class and different security types, and using hedging where it makes sense, and having a rebalancing discipline. So every 3, 6, 9 months, you sell your winners and you buy your losers. And you're like, no. I want to sell my losers. I want to get rid of them because I was wrong. Look, there's a difference between investing winners and losers and other types of winners and losers. And the I guess the adage is, Paul Tudor Jones, famous macro trader. There's a picture of him in his Virginia dorm room with a sign that says "Losers average losers." Right? And so basically what he's saying is only a loser buys more of something when it goes down, right? Okay, but that's the opposite of what you just said, Mark. You're supposed to buy things when they go on sale. Difference. Paul's a trader, not an investor. It's a very big difference. And not good or bad, just different. Investors, right? People who do the work, right? Do the work to understand the value of an asset relative to its price. When the price is below the value, they must buy. And if the price moves away from fair value, you must buy more. When the price is above fair value, you have to sell. When the price is way above fair value, you have to sell a lot. Now, an investor is very different than a trader. A trader doesn't care about fair value. They just want movement. They want to scalp on the way up and they want to scalp on the way down. They're agnostic as to direction of market. And both are perfectly acceptable. Trading is really hard. The average person is not very good at it. It's because it's really hard to block out all the noise. about value and what does the business do, they don't really care. If the price is moving, they're buying it. If the price is going down, they're selling it. The real problem comes in late in the cycles, and we've all seen it, when you combine trading with leverage. Right? Here's the killer cocktail. Leverage can never make a bad investment good. It can and often does make a good investment bad. Why? Because you're forced to sell at the wrong time. So if you get a margin call and your assets fall in 50%, you don't get to sell that asset and pay back the margin. You have to sell some other asset that hasn't gone down. Well, that's the antithesis of what you should be doing, right? If you've done your homework and this is a good asset, you would actually want to be buying more. But here's the problem. You said it. The average person doesn't do their homework. They heard somebody mention something. They don't think about, was that person being paid to mention that? Does that person have a meaningful percentage of their net worth in it? Or is it one of 100 different positions? And, now we have the internet media. It's worse because now people do get compensated for talking about things on air. I mean, I never do, but I mean, that's just, my choice. I don't want to be compensated, but I think it's an interesting dynamic when you think about crypto and why we have this 4-year cycle. And, we're in what I refer to as crypto summer right now. Well, what is crypto summer? Crypto summer is that time where the market has a generally upward drift. It's not dramatic, but slowly upward, higher highs, higher lows, just kind of, like a roller coaster, kind of moving its way up the track. And what causes that? Well, what causes that is investors like myself, I consider myself an investor, have done the work, right? We spend hours and hours and hours looking at the value models and said, okay, the Metcalfe's Law model of Bitcoin, which use Bitcoin as an example, is 55K. Now you can say, well, that number's silly. No, Tim Peterson, my buddy, has this great model. You should have him on the show sometime. He's amazing. And that model's been deadly accurate on the value of the model because any network can be determined, the value of it, based on this Metcalfe's Law and the number of participants in the network. Make a long story short, if the price at 29 is lower than 55, then as an investor, I should want to accumulate. I should want to buy, right? Well, then what happens is as we get toward the halving, that'll happen next, April, and next June we'll shift into crypto fall. In that transition post-halving, crypto fall is where the traders start to come in because we'll start to approach that fair value, and the traders just see movement. And again, it's not politically correct to talk about, but men and women turns out are different. I know everybody doesn't want to talk about that, but they are. And one fundamental difference is not having babies or not, but one fundamental difference is hunters and gatherers, right? From prehistoric times, there were hunters. And it doesn't mean they were all men, predominantly men. I guess there could have been some women hunters, but anyway. And then there are gatherers, the nurturers. Well, what's a skill you need as a hunter? You need head on a swivel, right? Because it's got all these things trying to kill you, and you're out trying to kill something.
Being aware of anything that's moving will always take precedent.
Anything that's moving. Like if somebody walks across my, outside hallway there, I will look at them.
Yeah.
If it ain't moving, I can't see it. And I have proof. And I know people say, I'm tired of this story. Well, it's true. My wife says, get the ketchup. I open the fridge. Honey, there's no ketchup. She walks up, grabs a ketchup bottle. If it ain't moving, I can't see it. So
the worst is when you reach into the fridge and grab it and move it out of the way to look behind it. Where's the ketchup? It's in your hand.
Yeah, where's the ketchup? Yeah, exactly. Yeah, I don't see it. I don't see it. But it is truly dazzling. And so and this is true, the vast majority of people trading happen to be men. It shouldn't be that way, but it is. And therefore, there's an exacerbation of this. And there's actually a lot of good literature on this. The difference between males and females in trading and investing. And it turns out women tend to be better investors because they're not as overconfident. They don't overtrade. They don't trade things they don't understand. Guys are like, oh, I know how to do that. But
we take the loss, then we read the manual.
yeah,
and we only read half the manual.
Yeah. Exactly. We read the manual eventually after we crash. But the part is that trading is fine. And the good traders come in and they'll actually push the price a little bit. But then you get above fair value. Well, now the speculators come in. And in general, speculators are not even evil, right? What is a speculator? A speculator is just someone who takes the opposite side of a hedger. A hedger is like a producer. An oil producer sells using the futures market. Speculators take the buy, because for every sell, there's a buy. Every buy, there's a sell. That's my favorite thing when people say, "Oh, there's excess buyers in the market." No, there's not.
It's exactly equal.
Yeah. Precisely equal.
Yeah.
And there could be on the margin, the next incremental trader could be one or the other, but there will always be an equal number, or the market doesn't work. So then the speculators are there, and they're fine. You know, the miners are selling their coins, and they need to sell more because the block rewards just went down. So the price needs to rise. Well, then the leverage comes in. And when the leverage comes in, speculators turn into gamblers. And the difference between a gambler and an investor is not just where in price relative to value, but also has to do with amount of work. Gamblers don't do any work. I heard that coin's good. I'm in.
And then they have the gall to argue why that my coin's better, yours sucks. And the only reason they're saying that is because they happen to buy it and they don't even know what the max supply or market cap is of the asset, but they own it, so it must be better.
Hey, look, I'm gonna get a lot of hate mail on this, but it's the average Tesla stock owner. They have no idea what the financials of that company look like. They have no idea what the margins are for an automobile company. And don't come at me in the comments, it's a software company. No, it's not. It's a car company. They make cars. And yes, there's a software element, but they make cars. And the cars depreciate, by the way. They don't appreciate, contrary to what Elon told us. But I find this cycle will get exacerbated and get exaggerated. And then when price exceeds fair value by so much, investors turn around and say, I'm out. I'm going to rebalance, because if I bought it early, now my weighting is really high relative to my anticipated desired weighting. And so I'm going to sell. Well, that triggers the downward momentum. Then the short sellers come in and they push it back down. And then people get margin called and we get the collapse. But that's when the cycle starts all over.
I wanted to ask your perception on, or perspective, I should say, on the cascading, just overwhelming best news in the history of Bitcoin. Some people think about all these spot ETFs sort of cascading in, especially I think everybody talking about BlackRock. Do you think, you talked about this sort of, I don't want to even call it immaturity, but I'll call it the immaturity of the investors in the Bitcoin and crypto space. Do you think that as the stamp of approval effectively has come from Larry Fink and BlackRock and institutions and smart money and real professional traders are coming in, do you think that that's going to change the dynamic of how the price action moves because there's going to be a little bit more maturity coming into the space? Or do you think it's going to move in parity with, as those new people come in, also the awareness of Bitcoin and crypto is going to exponentially grow? So we're still going to bring in a lot of people that have no idea what's going on either. Like, how do you contend with the change once institutions are involved?
Look, it's a fantastic question. And it kind of goes to the heart of where we are in this evolution of the cycle and of the technology. So if you think about how every technology comes into being, they all follow an S curve, right? So it looks like a big letter S, and the first 10% come in over the first decade. Then the next 80% come in over the next decade, and then it matures over the last decade. And you go from, the originators to the early adopters to the early majority, and then you have this inflection point. And I think we're about at that inflection point, because the first 4 years, I don't really count them because it was kind of a science experiment and there was like 7 people involved. And last 10 years, it's real. And
right.
so
Especially
I feel
this whole last cycle too. Yeah.
Yeah. Yeah. And so we're at that inflection point, and yes, institutions theoretically are better decision makers than retail individuals. The problem is a lot of institutions suffer the same problem because they're run by small groups of humans.
Yeah.
And those groups tend to make equally bad decisions. The pension funds in particular have a long history of being just as bad as individual investors. So I don't know that the institutional money coming in is going to be quite the panacea that everybody thinks. The thing I think is interesting is
I got to pause you there for just 1 second, just because this came into my mind, and I think you'd be the best person to ask this. A lot of people that I talk to are also wondering, along with institutions, if they're so traditionally long time horizon investors, is there going to be a weird sort of dynamic of trying to figure, especially because this is an emerging market, are they still going to be long time horizon investors, or are they going to be hedging and taking percentages? Like, are they going to be trying to buy near bottoms, or, a confirmed start of a bull market and starting to, to level, layer out near a top, effectively potentially truncating an exponential growth cycle, or them being involved? It's kind of a perplexing.
Again, another good question that's complex in the sense that not all institutions are the same. Right? There are long duration investors like endowments, foundations, some pension plans. There are shorter duration institutions. I mean, BlackRock would be that, right? An ETF is not a long-term investor, right? It's a daily liquid, tick by tick liquid asset that the institution BlackRock doesn't make the decision. It's the masses come in, the masses go out, assets go in. Look at ARK, right? It can go, lots of money can go in, lots of money can come out. Now, the scary thing to me is despite losing more money than she made, more money still going in to that ETF. So I don't really understand that. But the institutions are very varied. And if institutions like Citadel, right, which are the ultimate high frequency traders and day traders, come in, they have a fractional of a second hold period versus, Yale might say, I want to hold this for 10 years, or, I might say I want to hold this for a decade in my venture capital fund, which we do. So very different. And the other thing that I think is interesting is this is not new. We've seen this before. GBTC was the perfect analogy. We know what happens when a institution, right? GBTC was a Cayman trust. That is a institutional pool funded with all of this other individual retail money. Now, it couldn't be retail at first because you had to be a qualified purchaser, and then qualified investor, and then you had to buy it in the private markets. But then a year later, you could sell. So then people could trade it in their PA. Well, what happened? We hit the $10,000 fair value, and then we went ballistic. I mean, we went straight up, and everybody's like, oh, that was Michael Saylor and this. No, that was GBTC getting bought every day. Their asset base went from nothing, literally nothing, to I think 20 plus billion at the peak. And the thing about people forget is when the asset was 200 billion, and 20 billion comes in, you're like, oh, that's not that much. No, it wasn't 200 billion. At least 150 billion of that 200 billion was never going to move. It was the lost or stolen, and the stranded, and the hodlers, and the people who are still accumulating. It was maybe 50 billion of free float, 20 billion on 50. That's going to put some serious pressure. Now we got this again. We got a $500 billion asset, and 100 billion of it is probably the free float. We're talking about 30 billion. If 0.1% of the 30 trillion of assets that are engaged in ETFs, is according to Eric Balkunis, who's an interesting analyst, 30 billion on 100, that'll move the price. But what if he's wrong? What if it's 1%? What if advisors I have an advisor, and I haven't been allowed because, UBS doesn't allow you to own anything crypto related. When this thing gets approved and it's a BlackRock fund, they're going to have to let it be approved. They're not going to be able to say no longer, and then I'm going to put at least 1%. And if everybody puts 1%, now you're talking 300 billion on 100 billion of free float. That'll move price a lot. So, but the other part of your question that's really, really insightful is those institutions also hedge. So we've seen that, right? When the futures ETF was released 2 years ago, prices started to go down. Well, wait a minute. I thought people were buying Bitcoin.
Yeah.
No, they weren't. They were buying paper, representations of what could have been a Bitcoin, but there was no physical demand for spot. And the big banks were shorting, which is what they do in futures markets where there's the ability to create paper goods. Oil markets, gold markets, silver markets, palladium markets, all these markets have an element of manipulation, which is the word that, Chairman Gensler likes to focus on. Like, dude, you think the crypto market or Bitcoin market is manipulated? Have you looked at the triple leveraged VIX ETF lately? You want to talk about manipulation, or the ETNs that trade in agricultural futures or gold? GLD has been spoofed for years.
Continuing where we left off, we're talking about, you made an excellent point at the first half of this, which was this FUD campaign of the illicit activities. And thank God that a lot of that has been dispelled and people understand there's, look at how many hundreds of billions of dollars is still laundered by the Mexican drug cartels in the top 4 major banks in the US. So when we're talking about Bitcoin, and, we're talking about all these, the potential bad things that could happen. And now we have spot ETF on the horizon. We have the futures ETF that's already here. Futures ETF, in my opinion, has actually caused more manipulation than people want to admit it has, because it's allowing institutional players to suppress price or prop it up. Do you truly think that is there any water or weight in the comments around the fear of spot ETFs causing manipulation in the market? Is that more or less than the potential from a futures ETF?
Yeah, well, I think far less than from futures, right? I will argue the futures ETF, it's not a coincidence that November 6th, the day of the release of BITO, was the day of the peak of the market in 2021. That's not a coincidence. What futures markets allow you to do is they allow you to create commodities out of thin air. In the old days, if I had a barrel of oil and I wanted to sell to you, Kelly, I would actually have to have the oil, and I'd have to have the capacity to put it on a truck and send it to you before I could take the money. That was an oil transaction. And then someone said, well, but we have these electronic ways to represent physical things. We don't have to have analog anymore. I mean, think about, last week I went to the Foreigner concert. And when I was in college, I had the original Foreigner album, record, vinyl disc. And Lucky Rodriguez just didn't give it back to me. So wherever Lucky is someday, I heard he was San Antonio or whatever, he's got my Foreigner album and I want it back. But we migrated from albums to electronic. And, for a while, I would have my, electronic copy of Foreigner, Feels Like the First Time, their first song, and I would make a copy on my computer and I'd send it to you through a file sharing app. And you were happy, I was happy, but the music industry was very unhappy because they wanted you to buy your own, copy. And so now we have digital music, and so I can't copy and send. We all stream from controlled content, and the royalties get paid and the fees get paid, and the writers who wrote the songs actually get paid. So the world is a better place, but we have to pay our share. And so now with money, we have this ability to do the same thing. And the bearer assets come with risks. Right? Think about physical pieces of paper. They can get lost. They can get stolen. They can get burned up in a fire. They can be used for narcotics transactions without being traced. like they say, what 70% of dollar bills have traces of cocaine on them. I mean, that's the urban legend. But I use this example.
The funniest thing that always stood out to me when people would make that argument about illicit activity, I'm like, well, before Bitcoin or any crypto asset was created, every drug transaction that ever happened ever was with fiat currency. So it's like,
of course it was. And before that, it was that was with bartering beads or chips or copper coins, or, I mean, there have been illegal transactions since the beginning of time. How did people pay for the world's oldest profession before there was paper currency? We've only had paper currency for 1,300 years.
Yeah.
Before that, there was plenty of the world's oldest profession, right? So it's getting paid for with something. But I think what's so silly about that argument is, in the old days, I want to influence you, Kelly. We meet for lunch, and we're sitting on the bench, and I get up and leave, and I leave my backpack, and I'm walking away. Like, hey, Mark, you forgot your backpack, and I just keep walking, and you look in the backpack, and it's full of cash, and you're like, oh, I must have to do something nice for Mark. Not traceable. Nice transaction. I got what I wanted. You do your thing. And that's the way it worked. Well, now, if I want to influence you and I send you Bitcoin on chain, that's traceable.
Right.
Like Katie Hahn, she's another venture capitalist. She said, look, I was a federal prosecutor for 20 years. Given the choice between Sacco money and fingers on keyboard, I'll take fingers on keyboard 20 times out of 20.
They don't. This is what makes me really realize that the winds are shifting. 3 years ago, literally 3 years ago, towards the end of the last cycle, that was very there was mass ignorance around any of this kind of stuff. And my favorite was when Charles Hoskinson went and talked before Congress, and they asked him specifically, what can we do to make sure that we know what's going on? How do we make it transparent? And he's like, you don't understand. This is the most transparent asset class on earth. You can see the history where everything is spent since the day it was created. Now, are there ways to obfuscate that? Yes, and there always become new ways to obfuscate anything, but the mechanisms are there. If we just, for instance, the government or, whatever bodies trying to make sure and we do need some, bumpers on bad things happening, but at the same time, Bitcoin's all about trying to figure that out while also balancing it with freedom, right? So I think that's the argument with the CBDCs too. So
it's not about that, Kelly, and you know it, I know it. Actually, all the listeners here know it.
Control.
It's not about that, right? It's about control, right? It's pretty simple. The cash is not the evil part of the cartels in Mexico selling drugs on the streets of the United States and wherever else they sell them. I mean, not just the United States, but the cash is not the evil part.
Is it the CIA funding them?
Evil part. No, evil part is the people manufacturing the drugs to sell to kids, right? I mean, that's the evil part. And look, there are lots of reasons why illicit activities exist and why, people turn to an easy way to make money. It's easier to sell gram bags than it is to go get a degree and work in a job and punch your 9 to 5, and not always easier, but whatever. So look, those things exist, but to blame the tool for the mechanism of payment, I still to this day makes no sense to me. Charlie Shrem, free not Charlie Shrem. Sorry. Crud. I want to free Ross Ulbricht. Not Charlie Shrem. Charlie didn't get in big trouble. He got in trouble, but not in big trouble. But Ross, he made a website. Arguably, the website is like a marketplace. We have marketplaces where bad people exchange illicit activity, like arms, drugs, all kinds of stuff.
Yeah, it'd be like being mad at the creators of the internet.
We don't put the founders of the New York Stock Exchange in jail, but we put this guy in jail for 2 life sentences. I mean, a little community service, right? Maybe teach some other people how to code. Much better. But it was denting, right, someone else's livelihood. And
in power.
that's the same thing here, right? Is money, well, one, it's the root of all evil, but two, it's the source of all power. And it's because, and it's really currency, not money. Money is a very unique thing, right? Money is an asset that exists in the absence of a liability. And there's really only one in the world, and that's gold. And it's been that for 5,000 years. And there have been other things that have tried to do it, from, little shells to stone tablets, but gold, persevered for 5,000 years. And everything else that we think of as money is currency. Well, currency is not really money, because currency has a liability associated with it. There's debt behind currency. And governments like currencies because they can issue them by fiat, right? By decree. And when you can do that, then you control things. And if you can buy up all the goods, this is the crazy part, right? This is called the Dictator Playbook 101. Yeah. So if you look at the history of dictatorships and empires, they all end the same way. You get a small number of people in charge at the top that own all the assets, right? They buy up all the assets. And then they devalue the currency, which basically steals the wealth from the bottom and concentrates it at the top, right? The Zimbabwe Stock Exchange was the best performing stock exchange in 2007, 8, and 9. I have a 100 trillion Zimbabwe dollar bill over there on my desk that wouldn't buy a loaf of bread. You look at what happened in Venezuela with the Bolivar. I actually have a piece of art out there where if you put an app on it, it's actually made with bolivars that are worthless. And they light on fire and Bitcoin pops up behind it as their savior for Venezuela. Because if you exchanged those bolivars for Bitcoin, as the bolivar went to zero, your wealth didn't evaporate. Look at what just happened in Argentina today. They devalued the currency and stole everybody's wealth again. Had you converted those pesos into Bitcoin. And here's the ultimate thing about Bitcoin. One Bitcoin is one Bitcoin. But we don't price it in Bitcoin.
But I want to pause you there for a second, because I
forget. In dollars.
I was sitting on a panel on Twitter Spaces, and somebody made a point. It just made me really realize how grateful I am, but also how myopically focused we can be, especially here in the U.S. Bitcoin is not only an asset traded in the U.S., and we argue here whether or not it's a currency or a store of value. And then, as you're just saying, you're talking about Argentina, Bolivia. We could talk about, down in the Congo, different places that have issues with currency, especially if it's controlled by another sovereign, a government. It may not be something that we use as a currency right now because we have capital we're trying to invest to expand, where other places there's no capital to invest to expand. They're trying, even with the swings in Bitcoin, it's a hell of a lot more stable than when you look at the Argentinian peso or the Bolivar or any of these things. So there's different use cases. There's different use cases based on where you're at.
It's only a swing if you look at it in dollars. There's never been a bear market in Turkey.
For Bitcoin,
Bitcoin priced in lira has only gone up. Bitcoin priced in bolivars has only gone up. Bitcoin priced in Argentinian pesos has only gone up. There's only this in euro, yen, dollar, Taiwan dollar, whatever. And it's the denominator issue. And I'll give you a perfect example, right? If you ask anyone listening to this, how close is the stock market to the all-time high? Oh, we're right there. We're right on it. Really? You realize priced not in dollars, but in gold, which is the only money that exists in the world, it's dead flat since 1997.
So
that's not true.
So no. So would that suggest then that the stock market is a good speculative price action chart that shows the actual inflation over time in a bizarre different
devaluation of the currency?
Yeah.
It's absolutely a perfect indicator of and that's true of every stock market, particularly in the flailing part of the end of the republic, right? I mean, if you look at empires, they flail at the end because they don't want to die. And what happens is you get these parabolic moves in devaluation. So here's the thing. 6 years ago, Larry Fink called Bitcoin an index of
for
money
money
laundering.
Yeah.
An index of money laundering. 3 weeks ago, he said, it's here to stay. And oh, by the way, you should probably buy some to protect yourself against devaluation of the currency. Let that sink in for a second, y'all. One of the most powerful people in the world. You may not like him or whatever. He's in charge of the largest asset manager on the planet, therefore is in that group of elite people, has just told you that all his friends are trying to steal your money. And now, which I think is hilarious, now, oh, and I'm here to help. Like, no. Satoshi was here to help 14 years ago. And I mean, I'm happy that they're going to make it easier for people. But the reality is, and this is where I got in trouble. I did another interview the other day and they spliced a bunch of stuff. And I hate when people do this. So if you watch the whole long form,
they created a different narrative.
The answer, and that's fine. But they splice some stuff together. And so a couple of things I said sounded out of context. And I actually did misspeak once on a word, custody. What I meant is where I self-custody does not change my ownership of my Bitcoin. If I put it on a ledger or some other device, it just doesn't matter. If I put it in a centralized custody, that's different. And so it is different if someone thinks they're buying Bitcoin when they buy the ETF, or they're buying Bitcoin if they have a Coinbase account. I get it. It's not equivalent, but that's not the point. The point is you have exposure to the return profile of the asset that you want. You just don't have to deal with the safekeeping and custody. It's no different in my mind. It is a little different, but it's not that different than buying a mutual fund or an ETF instead of buying the individual stocks. You know, you're paying someone a fee to take care of the stuff that you don't want to take care of. And yes, it can be confiscated from you in that form. Whereas if I have it on my ledger, short of someone pointing a gun at my family, they can't take it from me.
Yeah. I mean, I think this goes back to the incredibly fast evolution of the digital asset space from, it's not even, we think the inception was when Bitcoin was launched, but anybody that's looked into this knows that this has been in development since probably the mid 90s, if not or before that. But Bitcoin was
that's such an important point, such a great point. Like, couple things. It's not an accident that Satoshi Nakamoto's birthday is 4/5/75, right? That's not accidental. Because 4/5/33 was, Executive Order 6102, where they made gold illegal for citizens. Okay, so this, 4/5/75 is clear because 75 is when gold was legal again. So clearly this has been worked on probably even since the late 80s, early 90s, and then in earnest since the late 90s. And it is not a coincidence that it was released in the middle of the global financial crisis.
Yeah.
And the first image on the Genesis block is the chancellor approving the second bailout for banks. It's not a coincidence. And so it wasn't created on that day. It's decades of work. But all of that said, it's just a simple evolution of technology that is subtle but critical in that, well, wait a second. Why is triple entry accounting matter? I mean, double entry is fine. Like, well, no, it's not. And it's funny. We had Scott Stornetta, who is a venture partner of ours at Morgan Creek. And Scott, super smart guy. He's one of the co-founders of blockchain. Like, literally, he and his partner coined the term blockchain, right? Blocks in a chain.
Been around a bit,
And
I guess, huh?
been around, right? And this guy, he's amazing, brilliant. And if you read the white paper and you go to the footnotes, 3 of the 8 footnotes are his papers. Okay. And so, and he's been accused of being Satoshi multiple times. And it's funny, we interviewed him on our podcast, and people always say, so you must know who Satoshi is since you're in the white paper. And he starts speaking perfect Japanese. And basically what he's saying is, if you could understand Japanese, basically what he's saying is, it's certainly possible I could know who Satoshi is given, my work.
Hey.
But if I did, do you think I would tell you?
Yeah.
And I'm like, no, you probably wouldn't. Yeah. So, and no one really knows what he's saying because they don't speak Japanese. But the point he made, which I thought was so incredible, I never thought about. In the old days, I lent you money and I kept my book. Clay tablet, papyrus, single ledger. It was my book. I was the lender. You came to the center of town and borrowed money, and I was the money changer. And you come back to pay me back. And if I'm a scrupulous lender, I wrote down 100, you pay me back 110, all is good. But if I'm a bad guy, I changed the number to 200. You couldn't prove different. And I showed the authorities, look, it says 200. Kelly's a bum. Put him in debtor prison. And you had no recourse because you had to trust me. And I turned out not to be a trustworthy person. So the Medicis came along and said, no, that's a bad system. We have a better system. 2 entries, 2 ledgers. Kelly, you keep a book. Mark, you keep a book. And we, the benevolent Medicis, for a small fee, will make sure the books match. But here's the problem. The Medicis are corruptible.
Yes. So
what if I go to them and say, I'm going to change my number to 200? If I go to 200, I'll give you half. So you need a third person. You need a fourth person to check the third person. But they're corruptible. So you need a 5th person to check the 4th person. And a 6th and a 7th. He said, oh my God, you need the whole world to verify the transaction. And the light bulb went on. That's Bitcoin. And it's so profound that this old system that's been around for 800 years and generates $7 trillion of wealth for Larry and Jamie and Warren and all these intermediaries with their hands out taking fees from us. I'll tell you a crazy thing, right? I set up a foundation when I set up Morgan Creek years ago, copying from Julian Robertson. So he has the Tiger Foundation. I have the Morgan Creek Foundation. And we give a little part of our profits for education. And 19 years ago, when we set that up, I never saw this because I'm not an accountant. They started charging, the bank classified us as a business account and have been charging us $70 a month for 19 years for audit. You've never sent me a report. I've never asked you to audit. Long story short, they're like, you're a business account. That's what they pay. Like, for what? What am I paying for?
There's nothing different. Yeah.
No. Well, here's the worst part. So our accountant retired, and I said, you know what? My wife had also retired recently. I said, why don't you do this? You run a not-for-profit. Why don't you run our not-for-profit? And she saw this, and she's like, I got nothing. She went to the bank. She said, you cancel this right now. They're like, no, you have to have it. She's like, I do not, because I can go to this bank or this bank, and I'm not paying fees. Trust me. Magically, we're not paying fees anymore. Now, they're not going to refund all the fees from before, but $7 trillion a year gets spent on these superfluous fees, and that's all going away. Now, it's not going away tomorrow, and the incumbents are going to fight, which is what they're doing right now, which is this whole Operation Choke Point. But ultimately, triple entry accounting is going to win. Ultimately, digital assets are going to win. Ledgers are going to win. Tokens are going to win. And no, do we need Dogecoin in the world? No, we just don't. And Shiba and all the other dogs, no. But we need Bitcoin, and we need something like Ethereum. Maybe it doesn't have to be Ethereum, but it could be. And we need a handful of other platforms. Now, there are those that say, no, all we need is Bitcoin. Fine, prove it. Make Lightning scale. Give me an L3 and an L4 that I can actually make payments using. And then maybe one chain to rule all chains, like the ring from Lord of the Rings. But maybe. But between now and then, tons of things to do and tons of things to work on. But it's an exciting time because this is a technological evolution. It's not a revolution. It's not a bad thing. It's a good thing. And it's just exciting to see it all unfold.
Well, it's like when you go to a friend's backyard for a barbecue and the 15 people there, I guess everybody watching this, when you go there, you clean up your trash after yourself. But many of those same people, even me sometimes, if I go to a festival with 15,000 people, we throw our cup on the ground because the larger population gets around each other and there's this anonymity, you get diffusion of responsibility. Yeah. And then we have this idea that humans are corruptible no matter how good, what pressures may be put. And so now we have this huge, 7-8 billion person sort of globe with the mass diffusion of responsibility because now we're connecting on the internet and there's no face-to-face pressure or your community finds out if you're an asshole, right? So it's like this idea of the blockchain not only is, and I'm so happy you said this, Bitcoin absolutely needed, Ethereum or some smart contract platform that's their focus, needed. Having a trustless executable thing that multiple people, AKA everybody on that network, depending on what type of network it is, agrees. So you're not having to rely on trust and hidden fees. It's like, no, this is an agreement. Let's contract, let's execute it when X, Y, and Z happens, or this is money. I'm sending it to you. It doesn't need to go through Swift for 14 days because you sent $100 million and you're paying $38,000 in fees. I mean, there's so much is changing here and I could not be more excited. And I cannot tell you how much I appreciate having you on and hearing you, like being able to dig into your mind and just sit back with my notepad and go, tell me more, sir. Tell me more. So I hope we can have you back on.
I look forward to doing this again. And look, I appreciate everything you and the community does to educate people, to give people a platform, because it's hard, right? I mean, we're in the then they fight you phase. And, first they ignored us, right? 2009 to 15, a bunch of nerds and geeks paying their magic internet money. Have at it.
Yeah.
Then they laugh at us, right? 2016 to 21, bunch of nerds and geeks. You guys are idiots. Well, then they fight you because now we're right. And the fight part is hard. It's hard. You got powerful people with big agendas, trying to stop people and they've wiped out people's savings and I mean, and it's not just crypto. I mean, imagine being someone who worked at Silicon Valley Bank your whole life. You had all these options and all this stock and it's gone to the moon and you think you're rich. Gone. Why? No good reason.
Because they participated. Yeah, because they participated in a competing asset class. That's all it was.
And the amount, it's a parts per billion thing, right? They weren't, Silvergate. They weren't Signature Bank. I mean, they were doing God's work, supporting entrepreneurs and people who create things, venture capital firms. We use them, and it. Again, it's a longer story, but the idea that in the old days, a bank run was hard, right? You had to physically get on your coat, go outside, drive to the bank, stand in line, wait for your money.
But there was a chance the dissemination of information was slower too. So it was hard to get the mass grouping of people to go. Yeah. Now it's like Twitter. Okay, everybody knows in 10 minutes, and it's like
$42 billion in an afternoon. No fractional reserve bank can survive that. None, zero. And it's not a coincidence. And again, we'll leave it on this, but it's not a coincidence that the next day, the chairman, I guess she's not, Madam Chairwoman, Ms. Yellen is saying well, if you can't trust the banking system, maybe you should trust us and let us install a CBDC. Like, really? The body's not even cold?
Yeah.
And you just trampled on tons of people and businesses. And, we all heard the story of, it wasn't drug dealers. It was the husband and wife who were running a business in Ohio who used Silicon Valley Bank because no one else would bank them because they were self-employed and they can't make payroll. That's what you're taking down, lady. And to foment this FUD.
And let me see your track record, Miss Yellen. Let me see that M1 or M2 money chart, and tell me how you could print in the last 3 years more money than has ever existed in the history of ever. But you're on the right track, right? Let me trust you.
Oh yeah. Hey, the cult of Kelton is a tough one. But all right, okay, I'm gonna let you go. Really enjoyed it. We'll do it again sometime, and I appreciate everybody kind of staying tuned and listening.
Mark, I appreciate you again beyond anything I could say. I'll let you go. We'll see you on another time in another universe, hopefully within this galaxy of digital assets. And I'm riding the rocket ship with you. So I hope to see you up there and give you a high five when we're up there round and around the moon on the way to Jupiter. So I'll see you next time, and I'm going to move on with the rest of the community. Man. Thank you, brother. I really appreciate you. Now, everybody, make sure you go and give Mr. Mark a follow right here at Mark Yusko. As I said, so much great content he puts out regularly. He does interviews with everybody all the time. And every single one you hear, you're going to hear different content, and you're going to hear a new lens on. He's just phenomenal. Definitely give him a follow, and check out Morgan Creek Capital right here, morgancreekcap.com, to check out his other business, of which he is CIO and CEO. And again, if you haven't yet, make sure you're giving me a follow over here at Kelly Kellam. And of course, BitLab Academy as well, at BitLab Academy. Come give us a follow here. And again, before we go, I just want to again repeat, there's a lot of stuff going on in Maui. So many people have lost everything they own. I've got a bunch of family there, as well as probably 70 to 100 very close family friends who are all been there for 30 to 50 years, and they've lost everything. So if you could find it in your heart, head over to right here to tinyurl.com/Maui fire victims. And that is going to be basically a GoFundMe that we're trying to raise $100,000 to basically give out to the community and help people keep food in their mouth, keep clothes on their back, and identify what to do, because even those that have jobs out there, there's no job to go back to. So it's just an absolutely terrible situation. And there's also 2 more hurricanes, or typhoons they should called, in that area, headed in the general vicinity. So the worst is not over yet. It probably could get worse before it gets better. So any support that you could give, whether it's $1, $5, $100, whatever you feel comfortable sharing, it's going to go to people over there that have lost everything. So with that being said, make sure you head over to bitlabacademy.com, learn about how we break down this information and how we navigate these charts and how we jump in to understanding price action and momentum, and, using traditional markets to figure out what's going on in our digital asset ecosystem. And I just got to say, I hope to see you in there. Get involved. And with that, that's all I got. I appreciate you. And thank you again to Mr. Mark Yusko. Everybody, I hope you have a wonderful day, and I will see you on Monday. Adios, muchachos.